Hi, this is Randy Finney with Right Side of the Chart, and this is a late morning session update for Thursday, October 31st, 2019. All right, let's get into the charts here, and what I'll do is keep this one on point here. In other words, we'll just go over do an update on the charts I'm watching that I posted in pre-market today. So we'll start out here. We'll go through in order. ES. I've mentioned that ES, you want to see breakdowns in both ES and NQ. They're the two big large cap indexes that I follow. So ES, you need to take out not just these trend lines. We already had that first trend line. Here's the benefit of the Dow trend line, but then I said 3022 support, and if and when that goes, and I think it will, it's just a matter of when it goes. And again, with conviction, then we have a target down here about 2980. All right, so let's look at that chart. And here it is. All right, so we came down and we had what is that? We came down and the low was, if I can get the crosshairs right on there, it will tell me the low was, should be right there, 30, 20, 25. So we undercut 30.22, but just ever so slightly, and at the same time the Nasdaq NQ was at resistance. And I always say, don't trade these in a vacuum. Even most traders, I don't see a reason for trading ES and NQ at the same time. I tend to gyrate towards NQ because you just get more bang for your buck because it's a higher beta index. And if you get the call on the market going down correctly, usually NQ is going to drop more, and likewise if you get the call on a rally, you're going to get more bang for your buck there. However, I know some traders trade ES, and like I always say, whether you trade one or the other, you want to make sure you want to have confirmation on both breaking down, because one may slightly undercut support and at the same time the other hits support and then holds that support. So that's why you want to see both of them go. All right, so back to that chart right here. That was ES. Next one up was NQ. And there it is, near-term sell signal pending below the trend line, plus the 8040 support level with a minimum target of 7980. You can see it there, set a little bit above there, give or take. All right, so 7940, and I'm sorry, 8040, and there's the 8040 is this lower line right here. Remember, it's a level I've been harping on recently. We had a gap Sunday night. The futures shut down for the weekend, opened up, so that gap runs from about 8040 to 8050, and you can see, zoom in there, we never broke down in NQ. We took out the trend line on and the trend line's not super well defined. You have a few reactions there. This to me is the bigger level, and always in trading, this is a takeaway, I say this often, you give the benefit of the doubt. When you have two, let's say in this case you're looking at a short setup, and you have two support levels in close proximity, and the trend is currently obviously bullish if you're looking for a short setup, or at least in this case it is a near-term trend. You want to give the benefit of the doubt. Don't jump the gun on the first breakdown, because if some traders are watching the trend line, but everyone else is watching this, or more traders are watching the 8040-ish support level. And that's where the buyers step in. That's where the stock needs to break. And so you had a bounce there, and you could have covered, reversed short to long there for a bounce, or hold off at the very least if you're looking for a sell signal. But you can see here it looks pretty thin on the way down. What I mean by thin, it's just not a lot of trades. This is a thin zone right here. I don't have a volume price histogram up here. If I did, you'd see bars like this, big green and red bars on the volume price histogram, and you'd see some very small bars in here and then big bars down here like this. That's what a volume price, meaning this is where a lot of the trades went. This, although technically wasn't a gap, it serves the same net function there, is that we spiked right on through that level. Now if I go back in time, you'll see there were more trades that were at that level, but actually we'll go back pretty far here and not many. So where I'm going with this is when you have a thin zone works again a lot like, effectively like a gap, since there weren't a lot of trades there. Once you enter that thin zone, just like entering a gap, you tend to backfill it pretty quickly. So that's what you need to do. As you can see here, we break down there, so you want to get an early jump on it, wait for ES and NQ to break. Pretty much at this point, I'll say today's a break at today's lows. Let's keep it pretty simple. And if you're a QQQ or SPY trader, or SDS, SPXL, any of those leveraged TQQ, SQQ, I should say, same thing. Wait for a break at today's lows, or if it's an inverse, ETF, like I just mentioned, SPXL or SQQQ. Those are the 3-time leverage for the S&P 500 and QQQ. You want to see those break over today's highs, and that should do the trick because both of those came right down, tested support, and so far reversed. Now, I'm looking at, these are just, short-term trading ops at this point in time, but there is most certainly, I'm going to make this clear, and this is why I do these videos. I can sit here and talk for, sometimes I seem to ramble on too long. I like to keep the videos as short as possible, but there's just so much to trading here. And what I wanted to clarify is that although I'm laying out these near-term targets, and as I said, minimum targets, if we get these sell signals, of course, that's if or when, because we could push up on here. There's, we're in this wedge type pattern. The wedge could certainly continue to expand. That's just a potential setup until sell signals triggered. So whether we don't make a new high or we do make a new high and then we go on, if we come up here a little higher, then you'd have maybe a break of the trend line would be your first objective entry because you're higher. Right now, again, we were in close proximity today, hence the reason for holding off on a short there. But if you get higher up, then you have a little more downside to go till you hit that support zone, and then that would be your next sell signal. Now, so where I was going is this is a pretty well-defined support level, one at which I would expect a reaction if and when it got there. So short-term traders could either cover their entire position, maybe even reverse to a long, whereas a longer term, maybe a typical swing trader, because we do have the negative divergences on the daily, the 60-minute, the daily, the weekly, all the way out to the monthly charts, there is a potential that one of these shorter term sell signals or breakdowns could lead to a much larger drop, so therefore, a swing trader could, if you get a sell signal, take a short and put stops and maybe just trail them down to allow for a potential runner trade. Again, I don't see waterfall selling coming right now, but like I said in yesterday's video, where you got the VIX coming down close to support, things that are warning right now. We may be getting very close to the next swing trading op here. Here's the VIX right there, up a little today, but coming very close to that support zone, and I covered in yesterday's video. Sometimes it's a one and done. You kiss that top of the support zone and the VIX explodes. That means the stock market corrected. Right there was one and done, but here you hit it. You had a little hiccup in the market, and then you went lower, you hit the bottom of the zone. You traded around it for a while before the big move came, and that was a big drop last quarter. And so again, these are things that I'm looking at, and they kind of play into my analysis, where something as simple as that, maybe that short-term trading op, a breakdown for a quick pullback trade could trigger a longer term sell signal. So just want to kind of throw that out, and you guys trade it as you want. And yes, if you're probably wondering right now, I'm sure there's people thinking, well, Randy, what about TVIX? Yeah, well, you want to align TVIX with a breakdown in the market. TVIX, because there's a lot of decay, you don't see the same support level as you do on the VIX. The VIX is, you can't buy and sell the VIX. The VIX, the spot index that I was just looking at, nothing trades it directly. It is a it's not a hypothetical index. It's based on puts and calls and things like that. But the only way to trade it is indirectly via either futures on the VIX or options on the VIX. Those VIX futures, I should say. The options are not on the VIX spot VIX. Nothing out there trades this. This is the spot VIX. They only trade the futures on this. And you have various, near month, longer term month, and that's where these VIX tracking ETNs come in. This is the short term. So this one's tracking the short term futures, and then you have other ones like VXX, they trade, well, that's short term as well. What is it? VIXM, I'm trying to remember. There it is, midterm futures. Those go out a couple months, things like that. So let's not get off topic here, which I tend to do. Let's go back to the charts I'm watching and follow. RTY, you had a pretty impulsive breakdown. This is a small cap index, and that's why I say, you want to see the market breakdown, you need the large caps to break down. And RTY did break down, gave you a quick short trading op, hit that first support there, target, and it bounced there. Why did it bounce there? Most likely because at the same time it broke down, had a more impulsive breakdown, which it's still below trend, that trend line, when it hit its first target, and not by mere coincidence, at the same exact time ES and NQ hit those targets, those key support levels that I was highlighting, the trend lines and the horizontal support levels. So therefore, that halted the slide in RTY. And I can tell you with a high degree of confidence, had or if and when those lows, today's lows, those levels we tested on the large caps go, that's probably when RTY will break down. So maybe we bounce back test here on RTY about the time we come to back test, maybe, and again, this is just a hypothetical scenario, we'll see if it plays out, right? Maybe around the time you get a back test there, the large caps reverse and then go on to break down, and so you'd be looking at the next leg down, probably to at least this 1533 level in RTY. And again, it's these divergences that tell me that it most likely will break down and we'll get a swing, at least a short-term, if possibly a longer-term swing trade here in the indexes, including small caps right there. Okay, the next chart was gold, and I've spoke to this now for what, over at least the last week, when I started to see gold was more unclear, a little more ambiguous. I mean, we do have the triangle, as I mentioned, I talked about this. You know, we had a Fed meeting coming up, and gold's been a little bit whippy. I'm going to say that it's traded. We had a whipsaw breakout there and a whipsaw breakout to the downside right in front of the Fed, but so far, you know, we've broken out and we've been moving up since these lows back here along with Treasury bonds, and I've talked about this recently. That was this morning's chart, and I'm going to go to the updated chart of gold now. Let's pull that up. There it is, coming up here. It's rallying pretty strong. That's a pretty impulsive leg up. Again, nothing, when you put it in the bigger picture, just please don't forget this. The bigger picture is gold has been consolidating in for months now, and it's towards the lower half. It is in the lower half of that consolidation range, but you know, my views, and they haven't changed because of the long-term charts have not changed, the technicals. I view this as a, you know, most likely just a typical consolidation within a bull market. We've had a heck of a run in gold up to the point here where this range started. We're overbought. Everybody was too bullish, and that's what happens when, you know, you get the boats loaded to one side. You need to clear out some of that bullish sentiment. And as I talked about many times before, a security can correct in one of two ways or a combination thereof, and that is in time or price. So when I pull up gold here and we look at the daily chart, you can see this is gold. Let's just take away all the trend lines. You know, here's that, you know, it's been rallying, pretty strong rally so far this year, and here was a correction, somewhat in price and more so in time, and just like now, and that's a healthy sign. You know, nothing goes straight up. If it goes up too fast for too long, you have a bubble, and then the bubble pops and you get a crash. This is healthier price action for a long-term bull market to come up, have these legs up, periods of consolidation, and as I talked about, this appears to be a potential bull flag on the weekly chart. And you know, if we're looking for an upside break, so that upside break can come above the flag, and most importantly, once we clear the recent highs there. So that's my take on gold, and it is also the takeaway from that as well. Like I said, right now, you know, you can't give it a buy signal with conviction. When you're in a trading range, it's the nature of a trading range, we can continue to chop around. We have this run up. Here's obviously, as I said before, it'll be bullish if we could take out 1522. That's that previous reaction high, and there's quite a few reactions there. It's not just, you know, you look for a reaction high as resistance, but here I have, you know, numerous tags, and you know, around that level to help validate it. So you can go back in time and see that 1522, especially, most important when you're looking at a chart, it's more important to see recent reactions than the previous reactions. So right here, you can see that every major rally here, or decent rally, since, what is this, since late September right here, has been capped by 1522. So if gold can power on through there, you know, wouldn't surprise me to see a reaction if it does get there. But if it can break on through there, that would be pretty powerful. That could also take us out and give us that breakout on the weekly chart, breakout of the bull flag pattern. So, and again, the other takeaway now on this is, and I saw this leading up to, you know, the FOMC meeting, where the stock market has recently broken out to all-time highs, yet at the same time the risk-off assets, gold and treasuries, are rallying. That is a red flag. This could just be a temporary, blip, if you will, within this trading range. But the fact that both gold and treasuries are doing it, and our treasuries are, by the way, the #1 risk-off asset. That's where historically, that's where the smart money gold is more of a speculative play. A lot of retail traders buy it, institutions will, but the bond market is more liquid, and it's also more steady. That's their #1 go-to flight to safety asset when the smart money smells a correction or problems coming in the stock market. So when you see stocks going up and then all of a sudden treasuries start rising, because usually the two are inverse, that is a potential red flag. And again, may prove to be just a temporary thing or the start of something more. But hard to argue the charts are constructive right now in treasury bonds. So that's gold. That was the next one, ZB. I started pointing that out before we even reversed, that we fell down here. We were coming down recently to that 158-ish support right there, and we had bullish divergence on both ZB. This is the 30-year bond. This is the chart from this morning, as well as ZN, the 10-year treasury bond. So we'll look at those. We needed to see that trend line break, and then the 161.43 level. And where are my charts here? Well, I see Z. Oh, here it is, ZB. There it is. So boom, we broke out there. We've overshot the 160.143. That may be a momentum fueled overshoot because you had a lot of velocity or upside momentum coming into that. So we could kind of consolidate on that level for a while. I think it's a pretty level, but net, this is all bullish. It's bullish that we took out that trend line right here that I extended out this morning and in yesterday's video, I believe. And right now we're above that level there, but like I said, here's what I think probably happened. I think we'll continue up near term, whether we blip back or not. Any pullback to that level would be bullish. Maybe we pull back to the 141.43, and since the markets are primed, ready to close to breaking down, I think I see more upside in treasuries. So it's a great way to be diversified, and it's also a pure play. I know at least one trader mentioned today they went long ZB, and that's a pretty decent rally for treasury bonds right there. That is about measured out there about 2.25% so far off the lows. And that's again pretty nice return if you're trading ZB treasury futures. They're pretty heavily leveraged, and if you're trading TLT, I always say this, you can take twice what you could normally take, or sometimes more, in a stock fund like SPY or an ETF like SPY or QQQ. Why? Because you have a lot less risk and volatility in treasury bonds. So I talk about beta adjusted position sizing. Usually I'm adjusting aggressive stocks downward in size to account for the above average risk and return. But in treasury bonds, I use it in reverse. In ZB, I'll buy those that are highly leveraged, each contract, or TLT, you can buy more than you would normally in SPY or QQQ. All right, so that's that, and let's look at where's ZN. They're going to move roughly together, but ZN is the 10-year treasury bond, and right at resistance now. So this one, again, was highlighted all the way back here recently with this divergent low coming up at support as well. And you had a minor trend line right there. We broke out, and look, that's a pretty impulsive move. This, to me, again, is simply a red flag with the stock market making new highs and shrugging this off. And factor this in, guys. Yesterday we got the rate cut, which we knew was coming, and if I know I'm throwing a lot out here. I've been doing this a long time. The markets are pretty good at pricing in all known variables, so make no mistake about it. A quarter-point cut yesterday was virtually 100% or fully close to 100% priced in, so it was no surprise. So that was already priced in way back here. We knew we were going to get that. Okay, so what changed yesterday? Well, the Fed made it pretty clear they're not planning any more cuts. Not to say they're not going to do it, but they pretty much talked the market out of expecting a cut at the next meeting. Now, again, so they pretty much are standing by their mid-cycle, quote-unquote, mid-cycle adjustment thing where they came in with a few cuts and they're done unless, the market, needs it later on if they see some things coming. Okay, where am I going with that? Okay. So this tells me then this is not a sudden change for an expectation of lower rates, because we got just the opposite yesterday with the Fed coming out making it pretty clear, if it wasn't already, hey, don't expect any more cuts unless things get ugly or start to turn down in the market and the economy. So that means we have, factored out the decrease in interest rate fact, because there's only two things that are going to drive bonds up and down. When bonds rise, the price of bonds rise, it's because one of two things: falling expectations for interest rates, and they kind of go hand in hand. That's okay. That's falling rates, expectation for interest rates, which goes hand in hand with falling expectations for economic growth, okay, and inflation. That's that kind of all intertwined there. Economic growth goes down, inflation goes down, rates go down. The other thing is that will drive rates up is an expected drop in the stock market. In other words, the flight to safety bid. So again, two things will drive bonds up: expectations that rates are going lower, or expectations of volatility in the stock market, because the smart money, hedge funds, pension plans, they pull money out of the stock market and put it into safe bonds. So this tells me, and it's again my interpretation, but this is nearly a 100% of drive in a flight to safety movement, from institutions and smart money, not an expectation of lower rates, clearly based on what the Fed said. So at the end of the day, is it a temporary blip? Maybe, but it's also technically driven as well, and there it is. So we're at pretty decent resistance now. If you traded ZB, one of two ways: an active trader, I would say, book profits here and get ready to jump back in if it breaks out above, or on a pullback, because I still favor this based on my outlook for the stock market and everything else. It's just a matter of pretty extended, probably needs to consolidate unless the stock market breaks down. That's one thing. Treasuries can run. You can look back here and see when they want to run, they'll run. So either way, make no mistake about it, this has all been bullish price action recently. And again, this kind of also plays into my expectation that now at this point, a correction and a breakdown on those 60-minute charts on the futures is most likely imminent at this point, meaning probably sometime this week. I'm going to cover one chart that wasn't in this morning's charts I'm watching, because I did share this in the trading room for gold members, and that's Apple. Apple being one of only two publicly traded companies to have joined the $1 trillion club. You can see a breakdown here. We have a nice clean bearish rising wedge here on the 60-minute chart. We broke down before their earnings, and now we back tested. So they're up on their iPhone sales were down, but everybody's excited that they're making money on the wearables, their little Apple earbuds and other things like that, which is a good thing. I think that's obviously a net good fundamentally. That they're diversifying out their product line. They're not so dependent on iPhone sales anymore. But we'll see. Again, the market, technicals are going to rule the day here. So what I was showing in the trading room is, I believe it's an objective short. You're at that previous high as well. So you have the previous reaction high, and you have simply a breakdown, a back test. And my target here is this both this larger uptrend line right here, more significant uptrend line, and I have a nice support zone that runs from about 230, we'll call it 231 up to about 233 or a little bit above that. You can see there's a big old gap there, the gap right here. I'm trying to box tool it. You can see what I'm covering there. And then the gap was tested, the top of the gap, but the gap was not backfilled. So come down here, and either the top and or the bottom, probably come in and hit the bottom. I would overshoot that trend line a little bit is my guess. So that's an unofficial short trading op, and again, it's all about risk reward. I know for some reason people don't like to short the stock. Everybody loves Apple. It's probably the most beloved stock out there. Has a cult following with its products, and of course it's been a heck of a performer over the years. I know a lot of people are long this stock as a core holding in their portfolio, but I'm looking right now at least just basically a tactical trade, a pullback trade, and it may or may not pan out. But what I can say about it, if my target is hit from where we're at now, you're talking about a 6, almost 7% pullback. So you set a stop about 2 to 3% above, and you have a pretty decent risk reward profile. Maybe 2% stop and you're targeting, 6, almost 7% downside. That's, better than a 3-to-1 risk reward ratio. And I wanted to cover this chart because should this, unofficial trade play out, that will almost certainly bring the market down because of the high weighting that Apple has on the indexes. Okay, so moving through, next up was crude. I want to do an update on crude. Crude, I said, still offered an objective entry. I had parallel trend lines there. I showed you yesterday with the first one. We hit the second one. The positive divergences were still intact. And then so you need a stop somewhat below, not right on, or not, not at 53.78, but a little below that level. And let's look at where it is now. This will most likely trade in line with the stock market. Stock market took a pretty good leg down this morning to get to those support levels, but let me update crude for you here. Crude is hanging in there right now, so you still have, I'm going to take this divergence line because this is not a trend line, more so just a divergence line, so I'm going to, and it's a little hard to clunky, the drawing tools on interactive brokers, but there it is. So you still have what I call potential. It's not confirmed divergence. We had it here, we had it here, and we have it here. If we can turn up here and hold above this 53.79 support level, which we're trading on now, then there's potential. But that will most likely, not guaranteed, but most likely entail the stock market holding support and rallying. So my guess, if the stock market breaks down, crude will probably break this, and the next stop's down here. Those divergences could very well be extended, so maybe if we get just a pullback trade on the equity markets, maybe these divergences lines come down, and maybe we look to try the next long attempt on crude down here at 52.80 or so. But as of now, like I said, it's holding that support as the markets are holding support. So like I said, if you took a long there, I wouldn't give it much rope, maybe a little bit below today's lows or just below today's lows at this point, since we've already had a reaction on that level. So any jog down, you can see as I zoom in, here's this candle here. Look at both those bodies exactly on that 53.79 line. So when you get a 60-minute candle close below there, the support's broken. Okay, next up was the euro. This one's just been printing money. I mean, we've been long the euro. Well, not officially, but I've been hard since this breakout right here, this bullish falling wedge back here. And I mentioned several proxies. You can trade this one, E7, that's what I have, Euro futures. You can trade UDN, which is the US dollar short index, because a bullish bet on the euro is essentially a bearish bet on the dollar. I was going to post, I took a screenshot of the chart, but I was trying to just keep that. Gave you enough charts this morning. This is the dollar index. If you prefer these, you can trade DX, dollar index futures, or short UUP, or like I said, just go long UDN by UDN. It's a short dollar ETN. And so this was the bigger pattern here. We had a bearish rising wedge, or at least a divergent high there, followed by a trend line break, which coincided with that breakdown in the euro. And so now we have this downtrend line in which to provide objective shorts, just like the euro. Now the euro, like I said, that's where my focus has been. The trend line's a little more clean, and you can see here it's just offered multiple additional buying ops. It took to about this point before we established that trend line, but then I highlighted it here recently. Also, when we got to that level, I told you I favored a pullback off that 112 level, so that, some of you were able to book profits there, even short down, and then I mentioned it scale back in anywhere from this 111.47 support level down to the trend line, but not below. And so far that was a nice entry. We rallied back up. Now where are we right now? Well, we hit that 112.08 level again, and so I'm awaiting and expecting the next buy signal on a break above that 112-ish level, and then that should take us up to at least this next target here. And of course, on the downside, I might pull this trend. You could pull it a little bit lower, play around with it. Because we had a slight pierce through there, but pretty much a break below that level, and of course below the recent lows. Sometimes you have these uptrends, and you have a steep uptrend like this, and then you break that and you come on down here to put in a lower low, but you keep the uptrend intact. So it's not the end of the world. If we break that trend line, we may form a new one. Ideally, I'd like to see the euro stay above this 111 level right here. That's pretty decent support right there. And so again, near term, like I said, you're in no man's land between support and resistance. Not objective to buy here to go long or to short it. You could have shorted a pullback trade off there, but I'd rather wait and see a break above here for the next leg up. Okay, after the euro, I covered nat gas. We had the wedge broke down just before the inventory reports this morning, and the inventory reports really weren't, I guess they were in line. I didn't even read what they were, but the breakdown stuck. We didn't have any sharp moves, so once the inventory report was out of the way and you were still below the wedge, which you were right here at 10:30 a.m. Eastern, somewhere around here, that was then an objective time to short or add to a short. Like I said, someone, I mentioned this in the either in the comments, I believe it's in comments under today's post, that an aggressive trader could position short ahead of it. Because more often than not, if a chart pattern is clearly bullish or clearly bearish, and you're expecting a potential market moving event, such as in this case, the weekly inventory reports, or in the case of a stock, you're coming up to earnings, it has been my experience that much more often than not, which is not always, so you keep that in mind, more often than not is not the same as always, but more often than not, a clearly bullish or clearly bearish chart pattern will dictate which way it's going to go after that market moving report. So in this case, we had a bearish to rising wedge confirmed with negative divergence, and you broke down, and then after the inventory report, we came down where we already hit almost perfectly. That was my first target at 2640, and the low there was 2641. 1/1000th of a penny off, or what is that, one, because pips are in current in forex. I don't know what you call it here on that gas. It rounds out to the nearest tenths of cents. So either way, my point is that target's been hit. Now, based on the negative divergence, we'll probably come on down and hit one of these additional targets. And again, if we come all the way back to this trend line, that might offer a next objective long entry. Right now, usually you don't get one and done corrective waves like this. That would be a one and done. Usually if you're going to correct, you get at least an ABC wave like that, maybe down here. So I do favor more downside, but we did hit that first target. And what you do is if you took the short either before or after, you don't want to see it. Depends where you entered. I can't tell you where to stop out, because if you entered here in anticipation of a breakdown, or this morning right after it broke down before the inventory report, then you're going to have a different stop than someone that entered here. But at this point in time, really that's the big level I've been watching, 2.711. And as I said recently, we've had 3 failures there recently, or at or near that level, give it a take. It's a volatile instrument. It's going to trade through there a little bit, but that's essentially 3 failures there, finally followed by a impulsive rejection. Just like the first time around, we had an impulsive rejection there as well. So again, that's why I'm leaning towards another leg down, and I'm staying short for now. All right, I guess that was it. Yeah. That's all the charts there. And again, the new comment section, you have the option to subscribe if you like anything that was covered in that front page post. And please try to keep the comments below related to the post up above, and any questions you have. And again, you can either, if you want to subscribe to only replies to comments that you made, so you're not seeing what everyone else is asking. But if you're interested in anything there, just go ahead and subscribe to new follow-up on all comments, and that way anything that I add, because sometimes I do add additional charts or comments there. So that's that. And then you can see as I scroll down here, the ones in yellow are new. That's also a new feature to this. If you come into the comments section, it's going to highlight in yellow the ones you haven't yet viewed. Of course, I think you have to have cookies enabled into on your website or your browser to do that. That's what cookies are all about. They remember where you were on a website. So cookies are not a bad thing, guys. At least on a site like this. You don't maybe want cookies on some shopping website or something else. But all right, let's wrap it up here. And Beyond wasn't mentioned here. Again, we'll try to keep these on task. Beyond, I still like it. Here's a question. Let me look at Beyond, and then I'll wrap this up, because I should update that. We have an official trade, BYND. Yeah, I noticed earlier I saw it down, had a leg down today, some profit taking, but it's still above the recent lows. It's, right now, the same reasoning for adding it as a long yesterday is still intact. We had what I believe to be a potential selling climax the other day on earnings right there. We followed up the next day and we're still moving higher. And this is a daily chart here, but you can see that we didn't even take out yesterday's lows. So far we have a series of 1, 2, 3 higher lows and 1, 2, 3 higher highs. Yeah, it's very early makings in an uptrend. You can't get too excited about it. It's only 3 days, but so far so good. And I have a more aggressive stop, but at the very least, you don't want to see it take out. What was that Tuesday's low? Yeah, I think that was Tuesday's low right there. And then I think I have an official stop on the trade a little bit above that, just to kind of keep the stops tight on this one. Don't want to let it get away from us. And like any trade, everything I'm mentioning here, I list upside targets. I'll try to list stops. Always on official trades, you'll get a suggested stop, but any trade's either going to work out or not work out. Don't get married to it. The key to investing and trading is don't put all your eggs in one basket, meaning don't put them in one trade, one position, and cut your losers and let your winners run. Don't let a losing stock get out of hand. And a lot of these things that I'll throw out here like this are very aggressive trade ideas, meaning you can make double digits if we get it right, 10-20% in short order in days or just weeks, but you can also lose 10, 20, 30% on these things. And you take too many 20-30% hits on positions, and it's really going to put a damper on your returns in your portfolio. So remember to just use stops wherever you're comfortable with. All right, we'll wrap it up here. This has been Randy Finney with Right Side of the Chart. Hope you enjoyed it.